Oh bugger. Oh bugger. Let's do it. I don't even know what the day is. It's the 23rd day of October. I am Hugh Hendry, ladies and gentlemen. An absolute honor to welcome you back. Is this our 23rd day? I don't know. What will I speak about today? I do not know. Am I apprehensive? I certainly am. I believe I think we've got 2 economic data points. Let's do them, and then let's see what I can find in my tool of amusing anecdotes for Thursday. And wow, sorry, my mind thinking. Where did that Schrodinger's cat? I enjoyed that last night. Not sure where that came from, but I felt I learned a lot more about myself. Gotta give myself more credit for things. Credit where it's due. Anyway, the National Association of Realtors? Is that what we're gonna do? Is that what we've got? Is that all we've got? Existing home sales. So again, the whole notion of being plugged into the edge, the flow, the data. We got this gigantic $28 trillion humming mass of the American economy. And we get these data points. So September, existing home sales. It's kind of interesting, yeah. I am looking at a figure which is in 2 decimal points. I'm going to call it 4 million units. And apparently that improved from the previous month's 4 million units. Yes, I refuse to adopt this convention of looking at 1 or 2 decimal points. On a month-over-month basis, existing home sales rose 1.5%. That was cause for some cheer in some weird parts of the marketplace, because in August there'd been a very, very, very modest dip. So modest that I would call it flat. And anyway, who moves house in August? You go on holiday in August, but people look at it because it's a bellwether for consumer confidence. And it's way down, actually. How far down is it? Yeah, sorry, I was looking at the chart there. So 4 million units, we are just as like, what is it like? What would you call water skiing on your ass rather than on your heels? That market's been dragged along. 4 million units is kind of as low as it gets. So people are not moving house, because why they people are moving house. Forgive me. 4 million units. 4 million houses, existing houses were sold in the month of September. Seems like a big number, but that's been the average for this decade. I mean, forgive me, but there was a surge to almost 6.5 million as mortgage rates collapsed with the pandemic. But of course, then they went shooting back up. And so it's a good thing and a bad thing. The good thing is households in America got to refinance their home equity loans at rates probably less than 3% and fixed for the next 30 years. On the negative side, however, as the Fed raised rates, the most dramatic rise in rates since the late 1970s, Mr. Volcker, it is made you don't want to buy a new house because you'd have to get rid of your existing mortgage. And actually, I'm sure we had mortgage, the 30-year. Did I write that down? I did not. But I did. Mortgage rates. Yeah. The 30-year is coming down. That 10-year, we're along the tilts. Wasn't so good today. But the 10-year steadily, the yield is below 4. At the 30-year, with the 30-year mortgage, the benchmark 30-year mortgage, the lowest level, 2025. And I will here quote, I was going to say 2 decimal points, but I refuse, 6.2. So the existing home sales are, if you will, chugging along at 4 million, which historically is a low level, because the majority of the legacy mortgages are kind of set there at 3%, and to enter into a new mortgage today, it's 6.2. And everyone's like, you know what? I think I'm going to stay put. And if I do have to leave state for my job, I'm going to rent. I'm going to keep this, rent it out, and I'm going to then rent somewhere in another state. So much of a muchness, but I guess some flicker of enthusiasm that nothing is getting worse. And of course, what happens if rates fall a great deal? My dear friend, D-Lev, Mr. David Levison, has a very scintillating theory about that. We may touch upon that if I can get my mind to work tonight. We didn't have Dorothy. We were not doing The Wizard of Oz. But we did have, on the manufacturing front, we had the Kansas City Fed's composite index. And it says here for October, really? So that would be kind of late September into October. And it was really pretty good. It's one of those diffusion indices. Anything above 0 is expansion, indicating growth, which it was. The manufacturing index, it jumped from 4 to 50. So what's going on in Kansas? I think it's known for machinery and chemicals. And that's a little bit, well, it is in conflict with the national purchasing manager indices that we were discussing. They are the wrong side of expansion. So Kansas is a crumb of positive thought that despite trade worries and everything you hear about the economy, what do you hear about the economy? Things ain't falling apart. A nicer way, perhaps, of looking at that is we've got corporate earnings. We're thick in it with corporate earnings. And yeah, we want to know what the companies are saying. 4 times a year, they pick up the phone, they dial into the Zoom calls, and you see these boring guys and typically boring middle-aged gents in suits being very dull. I think maybe one of the standout ones today, like a proper, real company, a big company, Honeywell, $140 billion. And that was up 7% today. And profits were good, exceeded expectations. I hate that term, but it had a 22% jump in orders, record backlogs. It's got a lot of really good earnings visibility. So, there's something. Are they based in Kansas? No, they're not. I've actually visited parts of Honeywell. So building automation, Honeywell, do they have any, I'm thinking Otis was United Technologies, not Honeywell. But automation and a big line which is doing very well just now in defense and aerospace. And Honeywell is one of those stocks, as I jump between my charts, it's got a great long-term Honeywell. Forgive me, I'm looking. The stock long-term has been, oh my God, I've got, my screen is blocked. Where are we? Daily. We're daily, we're weekly. We're 5 years. Yeah, I mean, hello. The stock has done squat diddly do in the last 5 years. And again, my fascination with the 1 year. The 1 year is almost like this. It's almost like a butler holding the tray coming into the room to the master. What would you like? What would you take with your defense and automated building products? What am I talking about? The 1 year at 200 and the price at 220. So 1 year only 10% away. But the intriguing aspect is it's been in congestion for 5 years. And the barrier is 237. So we're only like 20 points away for Honeywell. And then if it takes that out, then maybe good things are happening to the well of honey. Oh my God, this is all wrong. What am I doing? And I am. Oh fuck. Trying to look at the more data quarterly. Yeah, I mean, Honeywell is one of those stocks which it's bottom left. The test is, where was it? If you look at the bottom left-hand corner, it should be down there. And the top right-hand corner, it should be up there. And so, yeah, it's gone from like 35 to 240 over the course of the last, 15 years? Let's do max. There we go. That's more like it. It's gone from like $5 to 240, and it's done that. The century, the last 25, actually that's 27 years. And look, I'm looking. Look at the chart. Sorry, I've got a camera. It's very boring if I'm in your ears. But Honeywell did this one of these stocks that peaked around the time of NASDAQ at the beginning of this century. It peaked at $70, and it went sideways for 13 years, and then you wanted to buy the breakout. And it went from $70 to 240. So it went up 3x. And then, like I say, for 5 years, it's gone sideways. Maybe it'll go sideways for another 5-10 years. We will wait and see. But anyway, I thought it was worthy of flagging it, bringing it to your attention, because it was that very rare event. It was a big price move. And actually, I was saying to you about VAR, and rather than just just what. You're looking for the day's biggest percentage changes in the indices and then kind of randomly talking about them. We were trying to put it into the context of how we're trying to be a little bit more professional and try and get some color that you don't necessarily achieve reading Reuters or Bloomberg articles or the financial press. And it's a pity they don't do this because it's a very established and obvious metric they could use. They should be looking for the stocks which which demonstrated Z or Z scores of like 3 and greater, if any. What is a Zebedee? What is a Z score? And so here I am in St. Bart's. Sometimes I go surfing. I have not caught a wave, I want to say, in at least a year. I spend all my time, it would seem, in cafes with friends and computers these days than on the waves or catching waves. But I see the sea every day. And most waves, you know where this is going, but most waves are small. And every now and again, there's a bigger one. But it's still kind of normal within the whole game of waves. And we get used to waves and we can determine averages. The Z-score tells you how far today's wave is from that average size of wave. And if the score is 1, means the wave today is a bit choppy, a bit higher than usual. The kind of wave that happens roughly 1 in 3 days, so yawn fest. If it's 2, it's quite a large wave, something you might only see about once every 20 days. Now, my surfing skill, the Z-score for my surfing skill, I think I'm a 0.75 on the Z scale for waves. But if the wave or the Z score reaches 3, holy Moses, I'm out of the water. Because that is, I'm saying 1 is a monster wave for me. What is 1? 1 is 1 every 3 days. You kind of get that price movement, percentage price movement. 3, monster. That's Keanu Reeves and Point Break and Patrick, whatever he's called. It's 3 times. That's typically 3 times higher than the typical daily wave. That's a big deal. It's a big deal because Bayesian normality and all that stuff. But on the basis of observation, a wave like that you see once every, I think they say 740 days. What's that? I want to say that's every 3 years of trading. There's about 252 trading days in a year. So imagine you got your daily iPad financial feed, or you picked up, or you were reading your digital version of the Wall Street Journal or the Financial Times, and it just said, hey, the top 5 positive Z scores and negative Z scores for the S&P yesterday were the following. You'd be like, oh, I must kind of look into them, because you want to know what created the wave. And certainly thankfully you've got this podcast. And I'm here to talk about those 3 Sigma events. The elements of the day that were so unusual that they belong far, far, far from the edge of what's normal. That sounds like my world. And so today, I count at least 1, 2, 3, 4, I think, stocks in the S&P had z-scores of 3 or greater, but not greater than 4. We had Dover Corp, which I think is kind of probably allied to Honeywell. We had Honeywell. We had Dow Chemicals. Now, don't get excited. The Dow chart is appalling. And we were talking about these purchasing manager indices. The Dow chart and the Dow commentary, by and large, favors those broader PMI composites rather than the Kansas. Honeywell is very much as if it's on the yellow brick road. It's in Kansas. What else did we have? We had, definitely aerospace. Do you know, within that, it was a two sigma, or it was a Z of two. Z's dead, baby, but there was a stock Amphenol, and I'm sure I must have invested. I recognize that name. And Amphenol, Amphenol. And for those of you that have access to price charts, do yourself a favor and look at that price chart. I will be sharing it in my Substack page, or I'll certainly be updating my Substack page tomorrow for all the charts that I mentioned today. Amphenol, that is one of the most remarkable price charts I think I've ever seen for a stock which, have you heard of it? I struggle to tell you what it does. It sounds so dull. Like it does electrical connectors. It connects things. So anything electrical and anything in Wi-Fi and routers, anything electrical that needs connected, Amphenol is your guy. They make great profit margins. They clearly have just delivered forever. It's a share price that begins at the very bottom of the screen and ends up at the very top. And it's just smooth. It's just smooth. I think it'd be very rare for it to have demonstrated a -3 Z score. And one of the things I do when I see that is I bring up its international peer group, and I'm looking for confirmation, because typically the stocks should have performed well. They're servicing an industry which has got this, obviously must have something very powerful behind it. And I came across a couple of Japanese stocks which would be worthy of consideration. Hit me up if you'd like to know those names on the fan mail. On the negative side, again, roughly the same. We had, actually, there was you're going to get, on the downside, you will get more, because when you get a profit warning, like a really bad profit warning, you'll certainly do like a -4, -5 Z-score. You will get absolutely flogged, your share price will. And so there's a stock, Molina Healthcare. Don't know it, I don't care. What was interesting for me is there are a number of natural gas pipeline and infrastructure companies. Williams, Kinder Morgan, to name a few. And they were all down like 5%. And that's these are high yield, like huge visibility, very boring companies. And it's very odd, as a head scratcher, why they should have, suddenly the volatility has become elevated. And I was looking at the chart of Williams, big in natural gas distribution. And I'll share the charts on the Substack. There's a chart which is almost 40 years in length. And 3 times we've been to kind of today's prevailing level, and then it's backed off. So it's another compression, a ceiling, a price ceiling. And I was saying to you yesterday with the 3 Sigma gold that when we get a lot of volatility emerging, and these Z-scores are telling you a lot of daily price volatility has emerged, that can be an indication of a trend shift, a trend change. So the trend has been sideways. Are we going to trend and break out? That may be wishful thinking on my part. Maybe they've rallied to that elevated high, and they've been there on 3 previous occasions in the last 27, 28 years, and they failed. And so there's a heightened sense of anxiety about those levels, and that's why we're seeing the Z-score. Regardless, do you see how just by focusing on the Z-score, there's a lot more to consider, that the data becomes richer in the possibilities. And again, what are we with the quantum physics? The super wave, oh my God, we're talking about waves and super waves, and the fuzzy cloud where markets are trying to consider all possible outcomes are happening all together. That's what I'm doing. You see how this Schoenberg, whatever he's called, you can see how this quantum notion of these random decaying atoms or stocks can set off a chain of events, which is quite fascinating. And I think, again, just staying with the guys who got really beaten up, the Williams and the Kinder Morgan, I'm touching at my cheeks. I have this really rough, just 2 little tiny patches of rough skin. Just do not respond to my copious amounts of coconut oil. I've actually reached a point where you get that cream that you put on that really hard layer of skin that you find on your heel. I'm now putting it there, and it's still making no difference. What could that be? Anyway, one of the strands of thought which emerged in my head today came from a tweet, a very long thread by, I took a picture of the guys. I've got to give these people credit. A chap called Shananka Anselm Pereira. And he writes about money, tech, AI, science. He just writes. A bit of a Bitcoin guy. And he's got almost 17,000 followers. And he wrote a very long thread, an excellent thread. Again, very much, I would call it very much in the, I can't say the shadow, but in the same vein as David Levinson's arguments. I should say more about David's arguments, but let me just do Shananka. He had a piece, and it was called the $7.4 trillion detonator, America's hidden liquidity bomb, which is about to obliterate every market assumption. Okay, that was his title. I'm going to try and hold that, and I'm going to try and, oh my God, try and do duty, and do duty or give credit and try and capture David Levinson's argument. And David's argument is, again, these are all points that I've touched upon in this podcast over the last 26 minutes. I've done so erratically, but we looked at the existing home sales. They're 4 million. We looked at the 30-year benchmark mortgage is at its lowest level of the year. It's at 6.2. We said that existing home sales are chugging along at a very modest level because the majority of households locked in their rate at 3, and so at half of the prevailing benchmark level. And so there's very little incentive. Like a new mortgage is grotesquely expensive vis-a-vis the legacy, the ones that people have. And so if they can, people are choosing not to either trade up the house chain, try and trade into a nicer neighborhood, or facilitate a move, an out-of-state move. That's kind of not happening. And that's all a function of events from 3-4 years ago, 5 years ago, 2020, 21, 22. And what we do know, and we like things that we do know, we like known knowns, which is that there was just a tidal wave, a 10Z scored wave, a wave that is so rare you might expect to see it once every 50 years or 100, and that was the pandemic. And it was the fact that the 10-year and the 30-year treasury bonds, which are so important because they end up setting the price of risk throughout the economy. That they, of course, the decline owing to the pandemic allowed for households, thank goodness, to survive the economic strain by having this windfall of locking in and reducing their monthly outgoings on their mortgages. But typically you have, so it's an event cluster. And the 50 years of normalized behavior, there's no event cluster. Rates are always kind of moving over time and coalescing around, if it's going down, then it ratchets down, if you will, and stimulates activity, or it ratchets higher and it stems and stymies activity. This one just went, it was a massive structural, it was a massive overnight reset, boom, to the floor, and this gigantic amount of mortgage activity took place. And so David Levitin hypothesizes that, and this is whatever this chap's called, let me get his name again. Forgive me, I'm not great with names. What's my name? Hugh. No, that's my name. Jean-Hugues Hendrix. But we're talking about Shananka Anselm Pereira. There's a fine name. David's argument is, again, there's this knockout level that, so the mortgage rate, we're thinking 3, we're at 6. But that would be predicated on 10-year. And the 10-year went to 50 basis points. And it's presently, let's call it 400 basis points. And who knows, but if the 10-year drops below 200 basis points, and it looks as if it's got momentum, 200 is going to go to 1.5% yield. Now, that's a pretty bleak economic environment that would have to necessitate that. Or is it? We'll come back to David in a second. You're at a point where you knock in suddenly that everyone that hasn't moved house in 3, 4, 5 years gets knocked in because the mortgage rate, the benchmark mortgage rate drops, gets dragged down by the 10-year, and it comes into the vicinity of 3%, and people go, wow, I've been waiting for this opportunity, and they move house. Now, they don't have to move house. They may just refinance their mortgage. Now, obviously, they only refinance it if the standard benchmark 30-year rate goes below what they paid. But there's a community. There's always people. I mean, their new mortgages that were taken out last year probably average 30-year rates closer to 6.5, if not higher. You can refinance them today. And so David can conceive of an environment, because I said to you, well, hold on a second. We just reviewed Honeywell results. We discussed the Kansas City Fed's manufacturing index. Dow Chemical, which is a bellwether business-to-business operation, just had a positive 3 sigma update. How on earth are we going to get to 1.5% yields? The IMF yesterday said global GDP growth it upgraded its estimates to 3.2 for this year and 3.1 the following year. Doesn't sound like the environment where the 10 years going to go to 1.5%. Albeit, having said that, it's kind of where the 10 year is trading elsewhere. That's a big statement, actually. And so I want to, let's just real time see if I can go to my various charts. And you have to, when I do this, I'm really not good at thinking and looking at my charts, but I'm going to do it. And so markets, interest rates, I want interest rates, boom. Let's do this again. I really shouldn't do these things because I can't speak and you're listening. Developed nations. Yeah. So I'm looking at the 10-year. Singapore is 1.8. Denmark is 2.5. Germany is 2.5. So 1.5 would be really low. 1.5 is, Japan, 1.5 was less than where Japan is. Japan is 1.7 today. Where's the Chinese rate? The Chinese rate is 1.8, 1.25 in Taiwan. Wow. Anyway, so it's like, really, what? Come on, we're not going to go to 1.5% on the 10-year. But again, keep Schrodinberg. What the hell? Hopefully I wrote this down somewhere. The cat, Our job is to have. I'm a fuzzy cloud. I am trying to conceive of every possible outcome happening at every possible now moment. So yeah, I accept US 10-year at 1.5%. That requires a lot of jazz. But then David comes back and Levinson explains the hedging by commercial banks of their mortgage book. And mortgage assets, mortgage-backed securities, mortgage assets, a lot of them sit directly on the bank, and then you've got Fannie Mae and Freddie Mac, and then they might trade them. That's a $13 trillion asset. That's an enormous asset. Okay, it's only 1/3 of the gold market. The gold market is inflated. And so David had explained to me, and there's a great video of this, I think, on YouTube or something on Substack. And he explained how the banks, it's so enormous, and they have to hedge all their risks because they're quoted on Wall Street, and they grow predictably, and they don't want their earnings to be blown out by a lack of hedges. But the sizes are so monstrously great that they sometimes find themselves in a reflexive cycle where we were in a reflexive cycle where to hedge their book. So the previous cycle, the banks went from having their mortgage asset had a lot of duration, which is to say the risk of people refinancing it was very modest. That, there was again, if we think of Z-scores, there was your kind of average wave. There was your kind of wave, which is the one you get every 1 to 3 to 5 days. Let's call that 1 to 3 to 5 years. And then there's the really big monster wave, and that might be the one every 50 years. We got the 50 year with the pandemic, which absolutely blew out the risk profile of this very safe asset residing on the bank's balance sheet, the mortgage. The duration collapsed, and it meant that to re-hedge, dynamically re-hedge, they were having to effectively short 10-year treasury securities. And they were doing so at a point where the Federal Reserve had turned around and went, oh, we thought inflation was transitory. We put $6 trillion of expansion into our balance sheet. And wow, we've got domestic price inflation. It's growing at 3. Oh my God, it's expanding at 4. It's expanding at 5. Expanding at 6% per annum. Peaked out at 9.3. And so the Fed went from, we've got 0 interest rates, and they raised interest rates all the way to 5.5%. That was not a good environment to be long dated treasuries. And in fact, the bankruptcy of several of those regional banks. Silicon Valley, of course, is the name most people associate with it. They went bankrupt lending to the US government. They went bankrupt on the price reset of the Treasury. Now, that's not what I'm talking about. I'm talking about that price reset on the Treasury and its impact on the mortgage book meant that with the Fed raising interest rates, with everyone crying fire, fire with regard to inflation, with every hedge fund in the world wanting to short sell treasuries, the banks, just to hedge their book, were selling treasuries. And so, wow, here we are. And may I remind you, we've just bought the TLT yesterday. We just put it into the portfolio again. Over the course of the last 3 years, the price halved. We took out all the price gains of the last 30 years. It's a big deal. So back to David's point, where the poo-poo people that, hey, I get it. We got to think about the cat in the box and the Geiger counter and the vial of poison and the random nature of atoms decaying. I hear all that. But, and I even hear that you might have a sulfur call option contract for 10 grand that might become worth $500,000 if Fed funds rates are below 1. But honey, the 10-year US Treasury ain't going to be 1.5%. And, okay, but David's point to that is, well, the other side, if, in the summer of 2024, 10-year rates were getting close to 3%. 3, then suddenly 2 doesn't seem that far away. And the rates and the 10-year rates in the rest of the world, like Germany, were definitely at 2. And so the point is, direction of travel, if we're going that way, you risk picking up this enormous reflexive machine, the US banking sector, which suddenly has to wake up again. It's like, beep, 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 alert, 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 dive, shut up, me. Forgive me if you were seeking a Zen moment of acid breath. But the books will start to be out of kilter, out of hedge once more. And they'll be out of kilter because refinancing will suddenly spike. And the banks will suddenly start losing mortgages. They'll be resetting away from them. And at that point, the banks, they do the opposite. They effectively come in and they are buyers of 10-year treasuries in order to get their hedging back. And buyers beget buyers, beget buyers, beget buyers. And reflexivity, it reinforces the direction and will magnify and probably accelerate the velocity of the direction. And that's how it's conceivable that we could get to 1.5%. And so as that happens, and again, we're trying to conceive Schrodinger's cat. There's so many possibilities when you don't open the box. Because one of the possibilities, and there's a hypothesis that kind of smart, kooky people have, like David and myself, that, I mean, do you know that we have a former hedge fund manager as the US Treasury Secretary? And so Scott Besson, you gotta think he knows this stuff. And what you have is you have this so the US is sitting so pretty. Data centers, the best companies, AI, automation, has woken up. It was Samson, it had his hair cut, and it was letting China walk all over itself. It's woken up and it's reshoring, onshoring. It's probably about 25% of the way through. There are difficulties. You know, there's the vulnerability from 40 years of being asleep with rare earth refining et al. But it will work it out. And those of you who followed my work closely, the high regard that I have for this US administration and its economic policy is that it was a policy that both sides of the Electoral College rejected. There was bipartisan rejection of this policy. It was like, we got to change. We're getting run over by mercantilism. We're being impoverished and we're going to be overtaken by mercantilist states. We have to fight back. But it was never accepted because in fighting back, you run the risk of destabilizing asset markets. Because the whole thing, you know, with these awful Gini coefficients, we've got a tiny part of the population that owns everything, which is, say, you know, whatever profession you have, the closer and closer it is to Wall Street, the richer you are. So the mercantilist state, the mercantilist sovereigns pumped America full of liquidity and made it a speculative society, and gave us the overvaluation of everything. Overvaluation of everything is a contentious title, but let's use that. The overvaluation of everything. And so if you're going to push the mercantilists away and say, no more, we will not be running an accommodative deficit for your surplus. We've not had the choice before, but actually we're setting in process fire breaks like tariffs to free ourselves of the tyranny of our common people. Going down that path, and the reason it was never accepted by weaker politicians was you run a risk of upsetting asset markets and asset markets falling precipitously. And, you know, like turkeys don't vote for Thanksgiving or Christmas. What this American administration seems to recognize is they've got, if you will, a parachute, which is that if you do get destabilization in asset prices. That's another factor which would cause the 10-year to slope and trend, the yield to slope and trend lower. And it begins to trigger this event risk of suddenly an enormous $13 trillion asset refinances. And the amount of locked equity, mortgage, property equity gains suddenly that get extracted, alongside the fact that the AI spending is going to be running at kind of 10% of GDP for the next 20 years. The US is not going to have a meaningful recession. And so it's unlikely it's going to have an asset price depression either. This is some of the things I thought about daydreaming today. I'm just amazed where this stuff comes from. As you know, at the beginning, maybe you want to skip the first 5-6 minutes until I wake up. But I'm awake. And so back to, God help me, what the dick is, Shananka Anselm Pereira, my dear friend. I'm going to call you SAP. You are the SAP of tonight's show. You're not a SAP, but you're SAP. You're software, organizational software. His little paper was vibing on this, and it just, there's always just little tiny things, so thieves, robbers, breaking in to safes and opening doors. They do it with, I don't know, I'm looking for something on my desk. They do it with twisted little pieces of wire, twisted little thought bubbles, if you will, is the analogy I'm drawing with. Twisted little thought bubbles during dreamy sequences of the day, I've always found act like a key that unlocks a door into the vast chasm of what's going to happen tomorrow. And so Mr. SAP made this really good point. Okay, something you know, but let's just say it again. There is just under $8 trillion in money market funds, cash funds. Just under $8 trillion sitting there today. And again, there's a jump risk. So there's a jump risk in mortgage financing, and there's a related, parallel jump risk. Oh my God, we're at 49 minutes. This is going to be over an hour. Shall I stop? Shall we save this for tomorrow? No, let's keep going. There's a jump risk that there's a level of Fed rates, and the Fed's going to be cutting. Next week, it's going to be cutting next week. And there's a point where that $8 trillion is going to go, remember, 2 nights ago, we were setting up our fund. And you don't buy anything for cash. You don't buy stocks for cash. You don't buy bonds. You don't buy currency positions. You don't buy options. You buy nothing for cash. Only about 10% of the fund. There's only about 10% of the fund's cash that I can't touch because I've given it to a broker's using its collateral or margin to allow me to have a risk position in stocks, et al. And so I'm saying to you, I've got $1 million fund portfolio, 900,000. What did I say to you? I'm putting it into effectively a money market fund. The 1-year treasury presently is 3.6. Now, 12 months ago it was 4.5, 4.75. So the 8 trillion is going, should I stay? Should I stay or should I go? Should I stay or should I go? And so that market, it's not a new market. This is a market that's got form. So again, we can, like waves. And there are distinct jump events from history. And they're very revealing. That's what SAP's Twitter piece today, that was the little thought bubble, which I put together with Mr. Levinson's arguments. 1998, LTCM, and Thailand is blowing up, and Russia's defaulted on its domestic, not just its overseas debt. Very rare events. LTCM's leverage is so great. These bloody Nobel economists that no one challenges, they nearly blew the world up. What did the Fed do? It slashed interest rates. There was $1.3 trillion in money market funds. 1998. What happened back then? 1.3 trillion slid like a tsunami into the stock market, and we had the bubble, which culminated in the TMT peak in March 2000. Let me say again, the possible catalyst, 1998, there was $1.3 trillion in money market funds, and the Fed cut rates, and the money jumped. 5 years later, and the bubbles burst. And remarkably, Greenspan, I mean, the NASDAQ had to fall about 60%. Again, thank you, Mr. Levinson. Had to fall about 60% before Greenspan really came in and started aggressively cutting rates. So 2003, of course, with all that hell on earth happening to stocks, and in fact, before it, forgive me, I'm back and forward, but the Fed had taken rates to 5 as it saw the bubble develop in tech. The 5, it was very, very slow to cut. So at 5, money had jumped back into the security, the safekeeping of the money market fund. And in 2003, there was now over $2 trillion residing there. And that's when, Bernanke's now the boss, and he's talking about helicopter money, but they take rates to what was deemed to be a level that we would never see. They took them to 1%. Fed cuts. 2 trillion goes, I'm jumping, I'm Zebedee. I'm out of here. I'm not in money market funds for 1%. Goodbye, folks. 2003, what happened then? The emergence of the housing mania. So we had a tech mania, we had a housing mania. 5 years. And manias and bubbles, manias, panics, manias, bubbles create panics. So we're now 2009, we're jumped 5 years again. And oh my God, we thought the TMT bust was bad, but wow, late 2008, early 2009, we nearly bankrupted the entire financial global system. And in between, of course, the Fed had pushed rates back up to 5%. So guess what? There's now $4 trillion in money market mutual funds, money market funds. What has the Fed been doing? Cutting. And what does the Fed do? It takes rates not to 1, to 0. And the money market funds are like, again, Zebedee, I ain't in this for 0 rates. Boom, I'm out of here, right? And we hit the rally of everything, which was 2009. So a long way of saying we've got $8 trillion in money market funds today. And the Fed's cutting interest rates. So it's really a nice time to revolt against the Chinese. Boom. And actually, So because of that debate, yeah, I was, my God, it's all related. I'm bringing it together. I'm excited. I'm pasting, I'm cutting, and I'm pasting, and I think this works. I was reading that, and I was like, God, what are those companies? Because I remember, I think I've said to you, I have invested in just about every stock known to man ever. I was called the centipede macro trader for a reason. I had like 100 legs. I bought everything. I've been in South Korea. I bought equities just about every country in the world. So I was like, oh, what are those American stocks? They're kind of like partnerships. They pay out all their income. They've got infrastructure, kind of gas, pipelines. Oh my God. I'm talking about Williams, Kinder Morgan. I'm talking about, I think EPD is the big, that one's got a 7% yield. And then I'm looking at Z scores, and they're all like boom, boom, but they were down. But I look at the charts look like they are stimulating to a chart reader like me. Again, they look as if they've been set up against a ceiling that might now become a trampoline-like floor to propel them higher. 7% yields. These are pretty riskless. Williams, natural gas transmission and distribution. Data centers. What did I say last night? Sam Altman and his crazy company is proposing to build nuclear power plants beside, and indeed I think Meta, someone's doing this. Nuclear power plant, and well, Microsoft wishes to do it with the 3 Mile Island. And yet we're in the continent of North America, and we have this stranded asset, which is almost an unlimited supply of natural gas. America is just the luckiest damn country. Natural gas in perpetuity. The cheapest natural gas in the world. These companies are yielding 3 to 7 depending on the corporate distribution tax structure. But they're all the same companies. They go nowhere for like 10, 15, 25 years. Potentially there's a tsunami of money coming out of the money market funds. And you've got a profit catalyst of this profound investment in data centers that requires energy. Interesting. Now, I wouldn't put these stocks into the portfolio. We've got TLT, and when my mind settles down, we said we put 25% of NEV, which is nothing. The next stage, when I get round to it, but we'll be talking about putting the same again, but into the what is it called? The strip, the ZR. I mean, where's my dumb? The Z. You put ZR and you get. Did you know Rough Rice Futures begins with a ZR? I did not know that. Symbol. Yeah, the 25-year plus zero coupon US Treasury, blah, blah, blah. It's a PIMCO product. Traded 1 million shares today. And let's bring up that chart. And this will be, yeah, oof, wow, yeah. So the ticker symbol is like zero, like Zorro. I used to watch Zorro when I was young, in black and white. Peaked at just on, like, let's call it 205. Yours today for 70. back at the levels last seen in 2009. Quite amazing. And so the next stage, next step, next addition, change to the portfolio would be a similar holding in the Zorros. I'm going to call them Zorros, and that'll be punchy. 25 in them, and 25 in them will be like a double position in TLT. So we'll be up to 75% in that trade. That's enough. Right. One last thought. Oh God, we're through the hour. So again, this talking about, there's a lot more going on. Sometimes I think I'm inventing this, but I'm sure there's a lot more going on, like very high mental processing in what is an economic war with the Chinese and the Americans. And so I think the administration recognizes like chess moves and what they've got with this jump risk, positive jump risk in their mortgage market, this $13 trillion asset. Stable coins and the whole, today Trump pardoned the Binance guy, US. So again, it's like, so Trump just wants to get rich with crypto. I mean, can I falsify that claim? No, I can't. Is there more to it than just, can we get past the circus drama of his personality? I hope we can. The stablecoin is just an astonishing weapon to use against mercantilist nations. I was saying, and I don't mean to be facetious, but the Chinese system is trustless. Their citizens don't trust it. And we're not allowed to trust it. We're not given the facility to trust it because they have a closed capital account. We can't trust their property valuations and property law by going in and buying property. You can't go and get a mortgage and own a house in Beijing. It's really hard. Yeah, you can buy an ETF, Chinese stocks, but you can't just turn up and open a brokerage account, etc., etc. So we're not really allowed to trust the Chinese. And the reason, and so they don't want to be trusted because they recognize they messed up. And the greatest example of this, and this all started this week in my head by, that 45 trillion dollar translated renminbi M2 broad money, basically $45 trillion worth, the equivalent of bank account deposits in China. And how it's such an extreme number. And I was frustrated that I couldn't do much about it. But it comes back to the trust thing. Is the Chinese shot themselves in the head. And the Chinese, I did say Chinese, don't I? I hope I didn't say Japanese, but they made an error similar to the Japanese. Let's look at M0. So high-powered money, the money that the central bank creates. And pretty much it's the money created by these trillion-dollar trade surpluses. And they're trillion-dollar trade surpluses presently, but they've grown to that level. But obviously 20 years ago, they weren't of that magnitude. But these small and smaller magnitudes were creating essentially the high-powered money and a dollar-anchored money that allowed for the expansion in the Chinese economy. So the high-powered money is about $1.8 trillion worth. That's the translation rate, which is to say it's like it's been multiplied 22 times by the banks. And so the M0, let's call it 1.8 trillion, that's got nothing to do with animal spirits in the banking sector. That's just what the central bank puts on the table. That's the asset. That's the real deal. That's the boiler room. The $45 trillion translated is what happens when you put it through the mixer and animal spirits create the gargantuan property cycle that we've just gone through in China. 22 times. Compare it to America. The M0 cash is about between 4 and 5 trillion, and M2 is about 22 trillion. So it's a factor of like 4 or 5, and in China it's a factor of 22 times. It's insane. So trust or trustless. If you're Chinese, you know this. Like, so the government's like, yeah, and the government is using your resources to pursue a lie. And the lie is the dollar renminbi rate at 7.1, 7.15. It should be 15. Like, the dollar translated value of those reserves should not be 45 trillion. It should be 15 to 20 trillion dollars. And that requires an exchange rate. It requires 15 renminbi to buy a dollar. But just now, the Chinese government, I said to you, what did I say the other night? The boy with his finger in the dike. The Chinese government is the Dutch boy with his finger in the dikes which holds back water, and is springing a leak. The leak is, everyone's like, wow, like, if I can get my money out, I can buy dollars for 7 when they should be costing me 15, 16, 17, 18, 19, 20 renminbi. And that's where we come back to stablecoin. Because the stablecoin is your mouse, your computer, and your VPN. Now, I don't want to overstate it, because you're breaking the law in a fascist society which is watching you. But if you are audacious and a risk seeker, and not greedy, but like trying to do better for yourself, you're hitting the VPN and you're trying to put your family's savings not into the Bank of China, but into Tether, USTD. You can buy like 2 to 3 times the number of stablecoins you will when this trust facade, boom, breaks down. And so actually, I was thinking about gold, and I was saying, it feels like the cat is like being is the taxidermist part for the cat. The cat's dead when it's meant to be transcending, but maybe it goes higher. Because again, actually, it's the American administration is loving this. America's got 262 million troy ounces. China will never have that quantity. No one will ever have that quantity. They're like the US is like 3, 4, 5 times greater in its holdings in absolute terms than any other sovereign. No one's going to touch it. And you start repricing gold. Well, we've done that. And we've taken the US gold reserves. They're now worth $1 trillion. That's 20%. You see, you've got gold backing, which represents 20% of your base high-powered dollar money. Now, let me tell you something else. The extraordinary thing is, it's not just me, but phone up Jamie Dimon and say, hey, Jamie, how many 30-year US Treasury securities are there in issuance? How many 10-year are there? How many 12-year are there? How many 15? No one knows. So we're all having to guess this. But David Levinson, and I've seen this corroborated elsewhere, long-dated treasuries with a maturity to expiry of more than 10 years, it's maybe not more than $5 trillion. That's not a big number. That's like an eighth of the capitalization of the gold market. And they keep telling you the US is, so all the attention is the US is reckless, it's the hegemon, it's Rome, and the empire. This is where empires fall face first into the dust. And it's nice, it's got prejudice. Like these nut jobs and rude and nasty. My God, have you seen that grotesque individual, I think out of London, keeps every day saying I'm a drunk and I'm a drug addict. Yeah, whatever, you got to accept it, But, what a dick. Anyway, is he sitting there at night working like I am? Is he telling you anything sensible? Hey, I'm not here to tell you anything sensible. Anyway, 20% of long-dated US government treasury liabilities are gold-backed. I mean, that is amazing. And Jamie Dimon was saying it might go to 10,000. And Jeff Gundlach, I've got a huge amount of respect for Jeff Gundlach, double line. He's a bond guru. He's like, you should have 25% of your portfolio in gold. I've got nothing. I've got 25% in Bitcoin. That's a lot of inside people. I mean, at 10,000, you've got 40% gold backing for long-dated US debt. You've got 40% gold reserves backing your high-powered money. The US is untouchable. So what I think is happening with gold is trust and truth are catching up with liar, liar, Chinese Communist Party, liar, liar, pants on fire. And the people and the movement in gold is actually the Chinese citizens, like, they're buying trinkets. Like, I will not be able to buy gold bars. Like, look at these rings. This silver and is this titanium brick? What is it again? Beautiful rings. Starling gear. Star Lingear. Go online. Go on Instagram. Like, beautiful knuckle dusters. I love these things. Boom. Rick, I love you. The jewelry business is Rick's having the best year ever. He's like, Hugh, shut up. So much so. So buying gold is like oil. It's priced in dollars, and so you are selling renminbi and effectively buying dollars. And the Chinese are a closed system, so they don't permit that. So it's heavily regulated. And any gold that comes in has to be registered on, I think, the Shanghai Gold Bullion Exchange. But what you're not reading about in your newspapers and your morning feed is that very recently, there's pandemonium in elite Chinese circles. The game is almost up. This feels like the fall of European communism. Dollarization always gets it, always brings them down. It feels like we're really close to the end of communism in China. That's a big statement. Banks are phoning everyone like, I'm cutting your credit line. You are not permitted. You're strongly advised. Strongly advised means if you do it, bad things are going to happen to your family. Stop buying gold. Was that the event that opened the vial and set the cat off into Deadsville? But I did say, maybe it comes back. It will come back. So maybe gold can hit even more preposterous levels. Because it's sponsored by the US. The US government wants it to happen. Think about that. Let's do acid breath for a moment as I regain my composure. The panic for the Chinese is, imagine. So initially it was a bit of a joke, and they were like, like we're trying to amplify this fear index and amplify fear in these democratic nations like America and Europe. Buffett, very anti-gold. It's a fear asset. What's the other great fear asset? The VIX. What's the great destroyer of wealth? Fear assets. They don't compound over time. Remember the example I gave the other day? The guy was telling me, bragging that if you'd bought a $20 gold coin in 1932, it's presently worth $3,900. And I said, well, yeah, but if you'd bought US stocks, you'd be worth $450,000. If you'd bought them just before the 1929 crash, it'd be worth like half that, $200,000. What are you talking about? So always buy equities and not fear. Anyway, God forbid if it went to 10,000 and you had 40% gold backing to the US government, and if the 10-year was triggering off that slide, that would just be almost like the US Treasury would become like the Bund. There's only like, I think 8% of the Bund, like long-dated bunds, are actually held by the market. The market would be, banks would be gagging Scott Bessent to issue more bonds. And remember, the majority, so there are 29, we don't know, but we think there's $29 trillion of Treasury cash bills, notes and bonds. Bonds is the 30-year moniker, I think. Notes is the 10-year up to 30. David will crush me if I get that wrong. Only 5 of that long-dated stuff, and it'll be 40% gold backed at 10,000. And the other stuff, the stuff that they were paying 5, might be paying 1. The US is so reflexively charged to be amazing. This is why America is taking on the mercantilist. And this is why I think China is having not a LIBOR moment. LIBOR, when the game was cooked, when hey, I am your banking counterparty in the euro-dollar market, and I don't trust you anymore. And we had these spikes in the London interbank official rates, which reflect counterparty risk. I think China, and we went from a trusting system to a trustless. I do not trust you, my friend. I do not trust your bank. Your bank is going bust. I do not trust you. And the Chinese citizens, in their rush for stablecoin and gold and now silver, I do not trust 7 renminbi to the dollar. It's going to be 50. It's going to be 17. So if I'm America, if I'm the American administration, I want gold to go higher. And maybe, because I didn't tell you, and I'm glad, it's funny. Things happen for a reason. I was annoyed that I didn't share a story that I'm sure many of you have seen. It's doing the rounds on YouTube. But Jim Simmons, Renaissance Capital, unfortunately he's dead now, but one of the world's greatest and probably one of the world's first rigorous systematic funds. And he recounts a story, look it up on YouTube, where he's talking about him and his investment partner in the early days in the 1970s. And they weren't systematic. And they were long gold. And it had been phenomenal. And Jim's like, I can't deal with it anymore. And he booked his profit. But his investment partner, Jim was superior in the ranking of the group. But his partner kept it all the way. And then one fateful day in January 1980, Jim was talking to his broker. Something I never did, but and his broker's like, God, Jim, like my wife, Veronica's gone crazy. And Jim's like, what do you mean? Veronica's so sweet. And he's like, you'll never guess. She was ransacking my drawers. And Jim's like, well, does she not trust you? She's like, no. She was looking for my cufflinks, my tie links, and bits and bobs. And she was taking it down to the jeweler. And he's like, because she was a jeweler. And he's like, so being a jeweler, the line that she waits in is less than the really long line that goes out and down the street. And Jim's like, what are you talking about? There are lines outside jewelry shops? And he's like, turn on the TV. And you turn on the TV, and it's the same image as our friends in Sydney. Long queue that looks like Northern Rock. And so to my Sydney friends who asked me to answer this question, the parallel with Northern Rock, thank you, because you got me thinking. You're beautiful. People, you help me when you join my Substack, and you help me when you send me messages and questions on Patreon, on Substack, and on fan mail. You help me. And it made me, and so the supposition was, the top's not in when people are queuing round the block. And again, that's in Sydney. Imagine the images they're not showing you in Shanghai and Beijing, in Wuhan. Imagine those images. But the top on gold is a top when the Veronicas of this world, when your wife is rumbling in the drawer you keep your underpants, looking for anything to hawk down at the jewelers. So maybe gold's going to go to insane levels. I don't know. I'm a provocateur. This has been the acid breath. This has been a very long show. I hope you agree. I think it was worth it. Thank you very much, David Levinson. And thank you all for coming back each day. My love to you all. Bisous from St. Bart's.